In this brief TaxSlayer Pro presentation, we'll talk about how the new tax laws will affect travel expenses. The Internal Revenue Service recently provided information and guidance to taxpayers and employers about the changes brought about by the Tax Cuts and Jobs Act that will affect move-related vehicle expenses, unreimbursed employee expenses, and vehicle expensing. The new tax law change will affect moving, mileage, and travel expenses, and will also offer higher depreciation limits for some vehicles. Briefly, we'll talk about changes to the deduction for vehicle expenses related to moving. The Tax Cuts and Jobs Act suspends the deduction for moving expenses for tax years beginning after December 31st, 2017 and continuing through January 1st, 2026. During this suspension, no deduction is allowed for use of an automobile as part of a move using the standard mileage rates that are listed in IRS Notice 2018-03. This suspension does not apply to members of the Armed Forces of the United States who are on active duty who move because of a military order related to a permanent change of station. Talking about changes to the deduction for unreimbursed employee expenses, the Tax Cuts and Jobs Act also suspends all miscellaneous itemized deductions that are subject to the 2% of AGI floor. This change affects unreimbursed employee expenses such as uniforms, union dues, and the deduction for business-related meals, entertainment, and travel. The business standard mileage rate of 54.5 cents per mile listed in IRS Notice 2018-03 was issued before the Tax Cuts and Jobs Act passed and cannot be used to claim an itemized deduction for unreimbursed employee travel expenses in taxable years beginning after December 31st, 2017 and before January 1st, 2026. Just recently, the IRS issued revised guidance in Notice 2018-42. Discussing standard mileage rates for 2018, the standard mileage rates for use of a car, van, pickup, or panel truck for 2018 are 54.5 cents for every mile of business travel driven, 18 cents per mile driven for medical purposes, and 14 cents per mile driven in service of charitable organizations. Taxpayers always have the option of calculating the actual costs of using their vehicle rather than using the standard mileage rates. A taxpayer may not use the business standard mileage rate for a vehicle after using any depreciation method under the maker's system or after claiming a Section 179 deduction for that vehicle. In addition, the business standard mileage rate cannot be used for more than 4 vehicles that are used simultaneously. Next, increased depreciation limits. The Tax Cuts and Jobs Act increases the depreciation limitations for passenger automobiles placed in service after December 31st, 2017. The maximum standard automobile cost may not exceed $50,000 for passenger automobiles, trucks, and vans that are placed in service after December 31st, 2017. Previously, the maximum standard automobile cost was $27,300 for passenger automobiles and $31,000 for trucks and vans. Notice 2018-42 is posted on irs.gov and contains information about the update to the standard mileage rates, including the details about the suspension of the deduction for operating a vehicle for moving purposes. This concludes our presentation, and we want to thank you for your attention.